Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's June the 17th, and we're looking forward to our webcast and update in terms of what's happening in the marketplace. We call this update transitory inflation because a lot of people are talking about, are we actually entering into this period of heightened inflation? So we want to just deal with that issue a little bit and then also talk about some of the companies that we have invested in. Now, the outline of the presentation, you'll see that on the screen there. The typical outline that we go through when we're doing these webcasts. Just a quick overview of ROCKLINC, investment challenges and what's happening there, market challenges, some of the things that are going on in terms of the stock market, bond markets, market developments, some of the items that we're dealing with now in terms of the overall market and some of the challenges there. Then we'll talk about a performance summary, and then I'm going to hand it over to Jesse Vandermeer and Andrew Cheng to talk about a couple of areas that should be of interest to you, the banking sector and also a couple of technology companies, which you'll find very interesting. Okay, so let's get right into it. In terms of ROCKLINC, just a overview slide there. Private investment company, as most of you know. We now have about $220 million in assets under management and about 200 families that we look after. We do focus on customized portfolios, and all of our investing is based upon independent thinking, looking at the current realities in the marketplace and then finding opportunities that can take advantage of that and trying to use an interdisciplinary approach or sort of create a worldview that gives us a very strong thesis in terms of where we are investing. Now, the businesses that we buy, I'll just leave this for you to look at. We talk about this on every presentation. Just let me mention that we are trying to buy excellent companies. We do run focused portfolios. We're looking at medium to longer term time horizons. We're not speculators. Very careful about the prices that we pay, so we're trying to, again, find a margin of safety. And looking at the economic backdrop is very important. The investment challenges, as we have articulated really since the very formation of ROCKLINC, but certainly over the last couple of years, have not really changed. If anything, they've just gotten more intense, and it's more important that we are, when we're investing, that we are incorporating these challenges into our investment thesis and the companies that we're buying. First of all, global debt levels. This is the number one challenge around the world. The unfunded government promises that governments just keep promising more and more, and citizens just keep accepting those promises as if somehow the government's going to make good on them. But that's going to be an issue going forward. The demographics, the aging of the world's population, birth rates have just plummeted right across most of the industrialized world at record levels, especially last year, 2020, 2021, this year with COVID. That actually had a profound impact on the decrease further in the birth rates. Monetary policies, which we talk about all of the time, this whole issue that central banks are just printing money and they're forcing interest rates to be as low as possible so that we can continue to service the debt. That has big implications for our investing and where we invest and how we try to protect our clients' money. And then this whole lockdown folly. This idea that you can just lock down large swaths of the economy and then fill the gap with printed money. And on the next slide here, let me just articulate a couple of the challenges in terms of this lockdown folly. I suggest here that the cure is far worse than the disease. Some experts who have looked at the impact of lockdowns suggest that the lockdowns have cost anywhere from 3 to 10 times more than the cost of the disease itself for this COVID-19. And when we look at the broader implications of locking down a society, they're very, very significant. And I'm just going to articulate these quickly. I'm just going to go through these because of time. But citizens and Canadians, we need to be thinking about this. And we need to be pushing back against government's extreme policies and their lack of proportionality when it comes to some of their policies. So we've seen the destruction of private wealth, private businesses, small businesses, businesses in the restaurant industry, tourist industry. There's certain sectors of the private sector have just been eviscerated, and we're starting to see a bit of that now, and we'll, over the next couple of years, see more evidence, and the impact of that destruction of private wealth will be will be seen in our economy. The state intrusion in the economy should be another very big concern. It's certainly a large concern for us that the state just continues to get more and more involved in the economy. What does that mean? It means less and less productivity. It means less and less wealth is going to be produced. It's going to be more and more frictional costs. And that is never good for long-term growth. Increase in sovereign debt. When I talk about sovereign debt, that's government debt. Pending increase in taxes. If you think we're not going to have a lot of increase in taxes as a result of the financial imprudence on the part of the government and the vast expansion of debt, then you're fooling yourselves. We're setting ourselves up for a large tax grab on the parts of government here in Canada and around the world. That also will have a devastating impact on economic growth as we give more money over to the government. Loss of freedoms, personal freedoms, liberty. Again, you cannot run a free, a capitalist system. You can't run a proper democracy without freedoms, and we've seen those freedoms limited in severe ways that are going to continue to have devastating impacts on our ability to grow and our entrepreneurship and the development of our economies going further in the future. Negative impacts on mental and physical health, not to mention a large increase in suicides. A negative impact on children and education. I don't have to tell parents who have had children in the public school system the last couple of years on the negative impact on their kids, and in particular, missing out on a lot of education in very formative and important years for young people. And there just seems to be no concern about this whatsoever. But again, there's going to be there are going to be serious, large, long-term, I should say, impacts of this. Increase in divorce, family breakdowns, stresses in the home, increase in substance abuse, and a massive backlog in surgeries and screenings. And this is going to be, again, devastating for our healthcare system going forward. So it's quite interesting. You've got government policies trying to protect our socialized medical system by having these lockdowns and keeping people at home as if you're somehow going to spread this disease over a longer period of time and protect the hospitals. But at the same time, you're taking away the wealth of the nation. You're strapping the governments with more debt so they can't fund healthcare in the future, which needs to be funded. And you're also creating massive backlogs. You're actually creating more medical problems, not less. And so we're going to have to live through this. It's not going to be pretty going forward. So in terms of the market challenges, inflation pressures are mounting in our economy. And so we've got a couple of points in this slide, which I'll speak to very briefly. First of all, stock market valuations are very high, so we're concerned about that when it comes to investing. So we're trying to watch the whole issue of valuations and be attuned to that. We don't want to overpay, and we don't want large drops in your portfolios if the market corrects. The central banks are still printing lots of money. We call that monetizing the debts. In the U.S. government, it's around $120 billion a month that they're printing. In Canada, it's somewhere around $12 to $15 billion a month in our own country. This is putting a lot of pressure, again, on inflation as you pump more money into the system. Unprecedented increase in debt levels continues, and we see this on every level, and right across the board here in Canada. Personal debt, corporate debt, government debt, they're all going up at ridiculously high rates. And then increasing concerns over the emergence of inflation. With all of this money printing that's getting in the system, with all of the money that the government has pumped into trying to replace the impact of closing down the economies, and some of the supply chain issues that we see, we've had this real spike up in prices in food, other consumer goods even, and in particular, we've seen it in asset prices, which I don't have to tell you. If you've looked at the real estate market anytime soon, anytime in the recent past, you realize that the housing market is up anywhere from 20 to 30% over the last 12 months, which is astounding. And again, that's driven by a lot of these very, very poorly conceived policies coming out of our federal government and also the central banks around the world. And so other market challenges that I'm just going to mention quickly here: structural deficits. Governments are addicted to deficits. We talked about this in one of our write-ups recently, this whole issue of universal basic income. The fact that the governments now are on this hobby horse that they're going to send out money to everybody. And we really want to push back against that. This would have a very large inflationary effect if you just started dropping money into people's hands and creating a base income for everybody. This is a theory that cannot be funded, and it will have long-term devastating impacts on our financial position in this country and on the economy. Central banks, as I've already said, are addicted to money printing. It's very difficult to stop. If they do stop, it tends to have a very negative impact on the economy and on the stock markets, and then everybody gets nervous, and then they're back printing money again. So there's this addiction to pumping new money into the system. Citizens are largely oblivious to the precarious financial position that nations around the world are in. So if you talk to people, to a large degree, they're somewhat ambivalent, and that's very concerning. And as investors, we have to really watch out for this to eventually run. Eventually there are going to be some problems, and people will wake up. But at that point, we want to be way ahead of it, and we want to be ahead of the game and seeing what's happening largely. And long before the basic population sees it. So again, a lot of people just don't seem to be concerned about all of these issues, which are not sustainable policies at the end of the day. And economists keep dreaming up new theories to justify this madness. We talked about this also in our last write-up. Modern monetary theory, they call it, MMT, means more money today. And basically, this theory says it doesn't matter. You can print money almost as much as you want, and don't worry about it. And we'll be able to just pay for everything with money, just new money, printed money. But listen, you can't just print money. You need production. You need to be building things. You need to be producing things, producing products, coming up with services. And if you're not doing that, printing money will have no net benefit other than to spike inflation, because you're going to have more money chasing fewer goods. And so this whole issue of inflation versus deflation is a very, very big debate right now. And as investment people, we're leaning more and more on the fact that we're going to have to protect your money from inflation. And that's because the government policies and the central bank policies are pushing inflation by spending money, big deficits, money printing. That will continue to feed an inflationary cycle. Now, if those policies changed and our governments all of a sudden tightened their budgets and central banks stopped printing money and lifted interest rates, then we would enter into a deflationary situation, and we're going to watch that. But currently, right now, we do not think that the inflation situation is transitory. We think this is actually long-term, and it's going to probably be picking up in intensity, and that's because the policies are being driven that way. Now, in terms of market developments, I just wanted to talk briefly about 3 items and how they're impacting your portfolios. And so the first one would be Canadian dollar headwinds so far this year. Then we're going to talk just very briefly about some geopolitical events, particularly to do with miners and some of our precious metals exposure. And then macroeconomic challenges, this whole issue of negative real rates of return as inflation spikes higher for the foreseeable future. So on this slide here, I just talked very briefly really about the Canadian dollar. A lot of times people say, well, my U.S. investments haven't done as well over the last sort of year to date over the last year. And what I want to just point out to you is that a lot of times your investment returns will be impacted in the short run by the volatility of the Canadian dollar vis-a-vis the U.S. dollar. So if you look at this slide, year to date, up until the end of May, our Canadian dollar appreciated, so it went up against the U.S. dollar by 5.4%. That means if you had a U.S. investment, that U.S. investment is down 5.4% just because of currency. So for example, if we have a U.S. stock that went up 10% so far this year, you think that's great. But actually in Canadian dollar terms, it would have only gone up by 4.6% because you've got to subtract that appreciation of the Canadian dollar. Now, that's fine. It doesn't bother us in the least, but it does, in the short run, cause these sometimes perceived slowdowns in terms of your returns, and people say, well, I'm not advancing as quickly and things like that. And it's largely currency moves, which tend to wash out over time. And we're not focused on currency moves. We're focused on the quality of the companies, quality of earnings, cash flow, and all of the things that ultimately drive long-term value. If you look at this slide also, you'll see year over year, May over May, the Canadian dollar is actually up about 14%. So it's been a major headwind for investing. But what I also point out is if you go back 10 years, if you go all the way back to 2011, our dollar at that point was pretty close to par. And so, in fact, that's been a benefit over the last 10 years, and we've picked up 14% return in total over that last 10 years because our dollar has gone down against the US dollar if you go back 10 years, not up. And that means then that U.S. investments are going to be looking more attractive and so forth. So the point here is, in the short run, our dollar has been quite strong because it's a bit of a commodity trade. Commodities have gone up, inflation's gone up, and people tend to put the Canadian dollar up in that environment. But not to worry. The second item I'm just going to mention is we made a few changes in portfolios because of geopolitical risk. And this is particularly geared to the mining sector and fear of nationalization in some of the companies that we might have exposure to. And so we've seen shifts in political ideologies, not just in Canada, the United States, as we've had this sort of leftward move and people becoming even more interested in expanding the size of government. But we've also seen this down in Mexico, Central America, and South America. And so these monetary policies that we've been pursuing have put pressure on some of the poorer nations in South America, Mexico, Central America, also in Africa, other countries in the emerging markets area. And so that's put stresses on the people in those countries. It's also made many of the currencies in South America more unstable. There's lack of education and economic knowledge about what's going on in many of those countries. And there's also a lot of community pressures being borne at the level that a lot of the miners are operating at. So you've got countries that are under pressure. You've got them moving to more government involvement. You've got unstable currencies in many of these regions. You've got people who don't understand what's happening. And then you've got community concerns. How are we going to pay our bills in many of these countries? And so what do? They go after the mining companies. They say, well, maybe we can tax the mining companies. Maybe we can get more profits out of them. Commodity prices have come up. Mining companies are making lots of money. And so the governments say, hey, if we're going to pay for some of the items that we need to pay for, let's increase taxes on mining companies, or let's just grab their assets and nationalize them. So this is an area that we have to watch if we're investing in some of these regions. And so we're keeping our eyes focused on Mexico, Central and South America, as I mentioned. We have low exposure to Africa through the companies that we have investments in. And that's another region that's suffers from bouts of instability. Currently, our focus really is Chile, Peru, Argentina, and Mexico. Those are countries of very strong interest to us because some of our mining companies and our royalty companies do have exposure to those particular regions. And that's because Chile, Peru, Argentina, Mexico are major producers of silver, gold, copper, and other base metals. And so the one country that is particularly on our radar screen and has been on our radar screen is Peru. And Peru just recently elected, it looks like this will become official. This goes back to June 6th, but it was a very tight election, a very left-wing, almost you could call him a communist president. And he has threatened to increase taxes on mining companies and also potentially nationalize. So now we don't know what's going to happen, but so what we did there is, so we had a couple of companies that had a bit higher exposure to Peru in terms of their overall portfolio and some of their mines. We reduced our positions in those particular companies and then shifted that money into other companies in the same sector, but they don't share the same geopolitical risk. And so we've just articulated that there. Pan American Silver was one that had about 4 mines in Peru. Wheaton Precious Metals, which is a royalty company but has large exposure through a company called Hudbay. And we shifted just a little bit out of those companies and took profits and then redeployed that into Agnico Eagle, First Majestic, Silvercrest Metals, Abitibi Royalties, and also Equinox. So we've done that shift. You'll see that in the portfolios, and that is to protect your portfolios and just be a bit more attuned to the potential, political problems. And then in terms of market developments, the last area I'm just going to mention here is this whole issue of negative real rates of return. I put this up here because it's important that you see this. What we're doing here is we're saying let's take a look at the inflation rate, what our inflation rate is, and then subtract the government bond yield, and let's look at the difference here. Okay. And if you take the the return that you're going to get on a government bond, and then you look at the inflation rate, actually that return on the government bond, when you factor in inflation, is quite negative, because the inflation rates are now running 4, 5, 6%, but the government bonds are maybe giving you 0.5%. And so you're going, well, I'm getting 0.5% return, but inflation is like 5% plus. That means I'm losing a ton of money by holding these fixed income securities. And that's really the plan here. If you got way too much debt and the government wants to deal with that debt, what do? You inflate it away. And so that's why they're trying to create this inflation. It's going to make it more manageable to look after the debt. But as investors, of course, you're getting really ripped off because your investment return can't keep pace with the inflation, because there's negative real rates of return. And so if you look at this chart here, you'll see that in the U.S. at the end of May, the real rate of return was negative 4.9%, almost 5%. So if you're just owning a short-term government bond, you're losing 5% a year. And that doesn't even factor the small amount of taxes you're going to pay on the interest that you do earn on your bond. In Canada, if you note the third country there, and you can look at the other countries at your leisure, in Canada, are the real, the rate of return you're getting is negative. So they've got negative rates of return to the extent that it's greater than 3%. So if you're owning a short-term Canadian bond, when you factor in the inflation rate that's running north of 3%, you're actually getting a large negative return. And so we point this out because we want to be very, very careful as we see this inflation coming. We want to protect you inflation, buy assets that will give us some inflation hedge. We want to be very careful about holding too much money in cash, because it's costing a lot of money while you're holding it in cash. So there's all these factors that we have to bear in mind in terms of investing. And then this last slide before I just give you the performance summary, this is just a reminder that 50 years ago in August, we're coming up on the golden anniversary, that gold was taken out as a backing for the currency. And that happened in August of 1971, where the currency backing of gold was taken away. We can see here over that 50 years that if you look at the U.S. dollar, it's gone from 100. If you valued an ounce of gold and then you valued a dollar of U.S. currency, you've seen that the U.S. currency has dropped to 2 cents on that dollar. So in other words, it's dropped 98%. The British pound has dropped even more. It's dropped 99%. And the Swiss franc has done the best. It's dropped about 91%. You can see it's worth 9 cents on the dollar, 9.49. And again, this is a reminder of what happens over time as countries inflate away their money and print money, and they're not financially disciplined. Eventually your money becomes worth less and less. And we have to make that up in other investments by buying investments that can more than compensate for the bad behavior on the part of the governments and the central banks. So those are the things that we're thinking about in terms of the big picture. And what I'm going to do now is I'm going to hand it over to Andrew Cheng, who's going to talk about the Canadian banking sector and some of our views there and our exposures. And then after Andrew, Jesse Vandermeer is going to be talking about the technology industry, and he's going to talk about a couple of new companies that we've been slowly just picking away in some of your portfolios, CoStar Group and Intercontinental Exchange. So over to Andrew Cheng, who will be speaking about the banking industry.
Great. Thank you so much, Jonathan. Over the past year and 3 months, the Canadian banking industry has shown itself to be relatively resilient. At the beginning of March of 2020 of last year, investors had some concern over how the Canadian banks would perform throughout the governmental lockdown restrictions. On the consumer side, there was concern that temporarily or permanently laid off employees would be unable to meet current loan obligations and would go further into debt. On the corporate side, there was concern that governmental forced shutdowns would significantly reduce profits and cause a surge in bad loans and force some companies into bankruptcy. In the second quarter of last year, banks set aside a whopping $10.3 billion for possible losses from uncollected loans and loan payments. These provisions for credit losses, or PCL, is the amount of money that a bank estimates it will need to set aside for losses from unrecoverable or default in loan payments. PCLs are recorded as an expense, which can negatively affect a bank's earnings. Now, the Big Five Canadian banks kicked off 2020 with a significant decrease in earnings. Each bank recorded at least a 45% decrease in earnings from the prior year. Now, this was significantly attributed to the $10.3 billion in PCLs that were recorded in the quarter. Now, concerns were tempered as the Canadian government and central banks stepped in to provide financial support, and this helped reduce some of the credit losses. The Bank of Canada decreased the key lending rate by 150 basis points from 1.75% in February of last year to 0.25% in just 1 month later. By the end of October of last year, the Bank of Canada acquired $156 billion in bonds. The Bank of Canada now holds a total of 35% of the total Canadian government debt. Now, these low interest rates have had implications. It helped drive a surge in mortgages growth, with the average mortgage balance at the Big Five banks plus National Bank to be $1.18 trillion at the end of April, which is a 9% increase from the prior year. According to Equifax, which is a consumer credit reporting agency, the number of new mortgages increased 41% in the first quarter of this year compared to last year. The majority of this new growth was from BC, which increased 59.2%, while Ontario new mortgage volumes increased 44.3%. This has led the Office of Superintendent of Financial Institutions to introduce new mortgage stress criteria to make it harder for new borrowers to lend for home mortgages. Looking at the consumer debt side, consumer debt increased just shy of 5% to $2.08 trillion in the first quarter of this year. Much of this was attributed to increasing mortgage debt, while credit card debt actually dropped to the lowest level in 6 years. Lower expenses from people working at home helped reduce the amount, or actually increase, the amount of cash that consumers had to be able to pay off this debt. And so non-mortgage delinquencies decreased 21.8%, while 90-plus day mortgage delinquencies actually decreased 19% in the first quarter of this year, and by 7.4% in the fourth quarter of last year. Mortgage delinquencies hit an all-time low, though there are some differences among provinces. This is quite significant. Now, near the tail end of 2020, Canadian banks started to improve in earnings and recorded lower PCLs. So in the fourth quarter of last year, the Big Five reported a combined PCL of $3.2 billion compared to $6.8 billion in PCL in just the quarter before, in the third quarter. Now, as we look into this year, the first half of this year, banks started recording loan loss recoveries, which is just a reversal of the provisions of credit losses in previous quarters due to improving expectations. The Office of Superintendent of Financial Institutions actually banned executive compensation hikes and also banned dividend increases and common share buybacks last year. Now, as we start to see things improve for banks and as restrictions of lockdowns start to be lifted, and we're starting to see bank earnings improve, we might start seeing a rise in dividend increases and share buybacks in the next few quarters to come, which will be beneficial for banks. And as interest rates progressively increase over the next while, this is also another beneficial for banks. Now, the banks had a significant contribution in helping to provide some alleviation in the economy of last year. Now, at the beginning of March of last year, there were 13 member banks of the Canadian Banker Association that provided a number of programs to help consumers and businesses. These banks deferred over 800,000 mortgages and over 1 million consumer credit products. These banks worked in tandem with the Canadian government to help facilitate direct deposit with the CRA to provide the Canada Emergency Response Benefit program. Over 3.4 million Canadians were enrolled in this program. The banks waived $112 million in fees for personal accounts and over $4.9 million in fees for small businesses. There are over 89,000 Canadian small and medium-sized businesses that received loan deferrals for a combined loan value of over $3.3 billion. Through the government's emergency business account program, there are over 879,000 loans that were given for a total value of over $47.5 billion. And these loans were approved and processed by the Canadian financial institutions. And many of these measures help keep businesses and consumers stay afloat. Now, TD Bank is a long-standing investment in ROCKLINC. Now, ROCKLINC client portfolios do not have a significant weighting, but we do have a position in TD Bank. TD Bank is the top 5 largest North American bank by total assets and deposits. It's also the number 1 ranking Canadian bank in terms of total assets and deposit. TD Bank it differentiates itself by primarily being retail focused, with over 85% of its earnings in 2020 coming from its retail banking, both in its Canadian and its US side. The retail banking business includes credit cards, auto financing, personal commercial banking, and wealth and insurance. The remaining 14% comes from wholesale banking, which includes its capital markets, investment banking, and corporate banking. TD has a large customer base of 26.5 million customers around the world. It also has a relatively strong capitalization. It's ranked number 1 with the highest common equity Tier 1 capital ratio of 14.4% last year. Now, the Tier 1 capital ratio is just a measure created after the financial crisis that is designed to be a measure of a bank's financial strength. TD has a significant number of ATMs, over 6,200, and over 2,300 retail locations across North America. Now, aside from the brick and mortar, it's also made significant investments in its digital capabilities as banking models shift from a brick and mortar to an online delivery service. TD has over 14 million active digital customers. Now, TD Bank does seek to differentiate itself from its peers. Since 2005, TD has grown its position in a very competitive US market by making strategic acquisitions and organic investments. Whereas other Canadian banks have struggled making inroads into the US market, TD has been very successful in developing its brand against existing established players. Now, if you were to travel into the US, you'd be hard-pressed. You'd be not surprised to see that bright green logo, particularly in the East Coast. From 2005 to 2010, TD spent $17 billion to aggressively build its US branch network and also buy up lenders along the way. It established a credit card, wealth management, and auto financing business during that time. The company has focused on standing out by offering better customer service, such as having longer operational hours than its peers. Even to this day, TD continues to strengthen its U.S. position. For example, last year, it sold off its stake in TD Ameritrade and acquired a minority stake in U.S. brokerage and wealth management Charles Schwab Corp. And we believe that this was a strategic investment in investing in a more diversified and more profitable overall business. Now, in 2016, TD also acquired Scottrade Bank, which is Federal Savings Bank, which helped strengthen its U.S. portfolio. As I mentioned before, TD has made significant investments in its digital banking capabilities and has been making great headways in increasing customer adoption and retention. For example, in the second quarter of this year, 62% of all Canadian retail and 50% of U.S. retail actively use online or mobile banking in the past 90 days. TD Bank also has a conservative management team that makes strategic acquisitions and investments while having a prudent risk appetite. This has helped keep it from getting in trouble, unlike some of its peers. And so we like a conservative banking model that does have growth, yet does have safeguards in the event of getting itself into trouble. And lastly, this is all translated into stable earnings and dividend growth. Over the past 5 years, earnings and the dividend has grown at a compound annual growth rate of over 8%. Now, the banks are still not out of the woods and there is still uncertainty, but we continue to keep an eye out on the banking and overall financial markets to ensure that our investments do not get caught up in any potential systematic financial risk. Now, with that said, we will now transition over to Jesse, who will explain the importance of network effects and give 2 company examples.
Thanks, Andrew. I'll be talking about network effects today and 2 businesses that we've been adding selectively to client portfolios, and that is Intercontinental Exchange and CoStar. So network effects occurs when more usage of the product by any user increases the value for other users. We see network effects, and we tend to think of network effects when we think of social media platforms, but network effects can be embodied in other businesses as well. And the 2 that I'll talk about today embody network effects. There's a few characteristics that these companies tend to display, and when they reach critical mass, and they're highly admirable characteristics that we like to see in the businesses that they own. The first one is high operating leverage. This is when the top line growth increases exponentially while the costs stay relatively fixed. This produces great profitability and high free cash flow generation. That makes sense. When you have a platform, the cost of adding one more user is very incremental to almost no cost. However, it hits the top line and almost falls immediately to the bottom line. The second characteristic of these companies is that they tend to have low capital expenditures. There might be high capex needed to build up the platform, but once it reaches critical mass, the capital expenditures needed to maintain the business tend to be quite low. And this produces when you have low capex, you tend to have high free cash flow generation if it's a strong growing business. And lastly, these businesses tend to display very strong growth. That's because that they can grow to the size of the entire market. There's only one or a few dominant players, and they tend to eat up the entire market because everyone is on 1 or 2 main platforms. So these businesses have very strong organic growth and can grow to the size of the market. So the 2 businesses, like I mentioned, is Intercontinental Exchange and CoStar Group. The first one, Intercontinental Exchange, you might not be familiar with the name of the company, but I'm sure you're familiar with one of their businesses, which is the New York Stock Exchange. They own several equity exchanges and several derivatives exchanges. And stock exchanges are a great emblematic display or manifestation of network effects. As a trader and investor, when you go to trade a particular stock or derivative, you want to go to the platform where there is the majority of other traders and investors. This, as we say in the business, liquidity begets liquidity. Investors and traders flock to that one platform because they can get the best liquidity or the best execution and price for when they want to trade in that security. And once established as the platform to trade or the exchange to trade, it becomes a mini monopoly for that security, whether that be a stock or in other cases, futures and options. Once entrenched as the platform, it's very, very hard to assail that moat. It's very hard for another exchange to come in and try and draw trading away. So stock exchanges are great network effects because they have a very strong business moat that is reinforced every day as traders continue to trade on their platform, and very hard to kind of assail that moat. So Intercontinental Exchange, we've been adding to the business selectively in a few client accounts, and it's the exchange business is a good business for those reasons. And a great business is when you can add other products onto the platform. So, for example, ICE or Intercontinental Exchange, they sell data around all that trading. So you have reinforcement of the trading on the platform, but then they also have data, which traders need as well. So it's this great positive feedback loop. Next is CoStar, another company you might not be aware of, but it's essentially a database and online marketplace for users and many different people that need commercial real estate information. It's a place where industry professionals and consumers can interact and facilitate transactions. So they provide info and analytics, whether it be price per square foot or selling price of a building or information on the building itself. Brokers, bankers, insurers, lenders, utilizers of commercial real estate need this information. And CoStar is the dominant player in providing that information. This position is reinforced as they continue to have strong relationships where they can add information every single day to the platform, keep that information up to date. It is the highest quality and most accurate. So they have this database that is basically unassailable. There was an example of another company trying to recreate CoStar's database, and they actually went out of business because it was so expensive and onerous to do so. Secondly, CoStar has an online marketplace business. So if you're a renter and you're looking for a place to rent, CoStar holds the number one brand in the business, apartments.com. And again, they have strong relationships with the apartment owners and they have up-to-date information. And it is the number one place you want to go in the US if you're looking for an apartment to rent. So like I said, these characteristics, these network effects, it makes it hard to replicate CoStar's database of information and its online marketplaces. And that makes it really unassailable as a business. And once they have the critical mass and the dominant position in the market, there's very high switching costs for users. You do not want to go to a platform where you don't know if the information is the most reliable or most accurate. And also, that means CoStar has very strong pricing power. In these types of businesses, it's great as well because you're relatively agnostic to the underlying market. For example, even stock exchanges, one of the best times for the business is when it's very volatile. So you're not dependent on the overall market. You just provide the platform for the market and collect a small fee for every transaction that occurs. It's a toll road on a whole industry, and it's the main toll road and the only toll road. So those are businesses that we tend to buy, and those are great ones to own for the reasons I mentioned. Tend to be high return on invested capital. You have strong free cash flow generation and outsized returns because the growth of the market tends to be quite strong. I'll turn it back over to Jonathan for closing remarks.
Thank you very much, Jesse and Andrew, for those presentations. Let me finish with our performance summary. And on the slide in front of you there, you can see that as of the end of May, our 3-month number was 4.6%, and our 1-year number 9.3%. And then over the last 5 years, we've been compounding just under 10% per year, and that's after all expenses. And that's based upon our total book of business, which is about 70% equities and about 30% in fixed income and other non-equity investments. And so we're very happy with that performance and continue to work very hard to protect your capital going forward and generate strong rates of return. Our next webcast is scheduled for Thursday, September the 16th. So I trust you all have a wonderful summer. And if you have any questions and you need to contact us at all, please email, phone us, or stop by the office anytime. We'll be here all through the summer. Thank you very much. Bye now.